Look at the scoreboard for the last 24 hours. The major indices are taking a collective breather, or maybe something heavier. The S&P 500, SPY, is down 0.75%, sitting at $681.92. The Nasdaq benchmark, QQQ, tracking those tech titans, is getting hit a bit harder, off 0.83%. Small caps, often the canary in the coal mine for economic confidence, are lagging slightly behind, with the IWM shedding 0.75%. This isn't a rout, folks. This is the market digesting a tidal wave of recent data, a feast of conflicting signals that are forcing investors to recalibrate their expectations for the year ahead. What's the narrative driving this slight retreat? It's a story of conflicting realities. Cooling inflation clashing head-on with a sudden hardening in the labor market, all set against the backdrop of ongoing geopolitical uncertainty and the looming shadow of political theater. The broad market weakness suggests that while inflation might be finally cooperating, the underlying economic engine, the jobs engine, is perhaps showing cracks that make bulls nervous about imminent rate cuts. When the data sends mixed signals, we pivot immediately to the people pulling the levers, the VIPs whose pronouncements can swing trillions in market cap. The political landscape, as always, is providing high-octane drama. We see coverage regarding Donald Trump, showing defiance as signs of aging emerge. In the financial markets, political stability is often priced in as a premium, and any deviation creates noise. Meanwhile, we hear about Elon Musk's X platform being fined $140 million by the EU for a lack of transparency. This highlights the relentless regulatory pressure mounting on the tech giants that largely underpin the Nasdaq's recent surge. If the cost of compliance rises, so too does the headwind for earnings growth. Speaking of tech royalty, Jensen Huang of Nvidia is emphasizing the critical need for the US to win a key people battle with China. This isn't just corporate talk, it's a geopolitical alert woven into the fabric of the semiconductor trade. The very stocks powering the market rally, the AI champions, are intrinsically tied to these high-stakes international competitions. And where is the captain of the monetary ship? Fed Chair Jerome Powell is reportedly quietly insisting he won't resign. A little internal drama at the Eccles building, perhaps, but the real story is the policy division noted in the macro data, divisions expected to carry into 2026. This suggests that while the market desperately wants a smooth pivot toward easing, the Fed itself might be more fractured, leading to less predictable policy moves. Down in the executive suites, Jamie Dimon is marking 2 decades at the helm of JP Morgan Chase, a quiet milestone of stability amidst the chaos. Contrast that stability with the turbulence surrounding tech founders. Michael Burry, the man who saw the '08 crisis coming, is doubling down on his skepticism, calling Tesla ridiculously overvalued, and linking it to an Elon cult. When contrarian titans like Burry speak, money listens, especially when they are targeting the high flyers. Now, let's move from the personalities to the plumbing of global finance, the bond market. While the equities look uncertain, the fixed income world is usually the one telling the unvarnished truth about inflation and growth expectations. The market is absorbing a crucial piece of news. US CPI data for November shows annual inflation easing to 2.7%. That sounds like a win, right? It should unlock the door for lower rates. However, look at the labor market data accompanying it. The US unemployment rate has hit a 4-year high. This is the classic conundrum the Fed dreads. Stagflationary whispers. Inflation is cooling, but the cost of cooling it appears to be rising unemployment. If the Fed sees jobs weakening rapidly, they should cut rates. But if they see inflation still sticky below the surface, perhaps due to supply-side issues, perhaps due to wage pressures, they will hold steady. The initial reaction isn't showing a massive bond rally, which suggests traders are hedging against the possibility that the inflation fight isn't truly over, or perhaps they are more worried about the job losses translating into a deeper recession than they are optimistic about a quick Fed pivot. This brings us squarely to the global central banks, where narratives are diverging like tectonic plates. In the US, we have the Powell situation, internal division suggesting a long, perhaps bumpy road to policy normalization. Over in Europe, the ECB narrative is colored by a fascinating piece of financial gossip. Christine Lagarde's pay is reportedly 50% higher than previously disclosed by the ECB. While seemingly trivial compared to monetary policy, high-level transparency issues always create underlying friction for institutions relying on public trust to implement difficult economic medicine. Furthermore, we see commentary suggesting that the old narrative, that woke policies are the real threat to Europe, is being countered by critics like Nouriel Roubini. These geopolitical and internal policy squabbles make forecasting the next move from Frankfurt or Washington significantly harder. We also look east. The UK inflation data, while less central than the US figures, is feeding into the broader AUD/USD outlook, which Citi Index ties to policy divergence. This theme of different central banks marching to different drummers, the US slowing, Europe potentially stabilizing slower, emerging markets lagging, creates volatility in currency pairs and complicates hedging strategies for multinational corporations. Goldman Sachs predicts US GDP growth will accelerate in 2026, despite the stagnant job market. If growth accelerates, the pressure to cut rates diminishes. This forecast effectively suggests that the economy might be finding a new, lower labor intensity path to expansion, or perhaps, that the recent job weakness is temporary, meaning the Fed can afford to keep rates higher for longer. This expectation is likely tempering the immediate rally in bonds that a bad jobs report might otherwise spark. The commodity complex is often a direct barometer of geopolitical stress and genuine economic demand, and today it's telling a fascinating story of divergence. Crude oil, benchmarked by CL=F, is up 0.70% to $57.82. This modest lift suggests underlying energy demand remains robust, likely supported by that Goldman Sachs forecast for stronger future GDP growth. Oil is sticky, indicating that despite any recession fears, the global appetite for energy isn't collapsing. But the star today, the one screaming the loudest about uncertainty, is gold. GC=F is up a hefty 1.67%, trading at $4,397.70. Why is gold surging when inflation is cooling, 2.7% CPI, and the dollar index, DXY, NYB, is actually slightly up by 0.07%. This is the sound of safe haven demand kicking in hard. When gold defies the dollar and defies falling inflation expectations, it screams two things. First, deep structural distrust in fiat systems, perhaps echoing Ray Dalio's warning about America being in a debt death spiral, where the US dollar is at risk. Dalio recommends shock-proof assets, and gold is traditionally the premium example. Second, it reflects the geopolitical temperature being turned up. The slight uptick in the dollar, coupled with the massive rally in gold, suggests investors are hedging against two different future states simultaneously: a stable, slow-growth US economy, supporting the dollar, and a massive underlying risk event that requires hard assets, supporting gold. It's a very sophisticated form of hedging. Let's return to the big tech names driving the SPY and QQQ. Their underperformance today, all negative across the board, tells us where the immediate profit-taking pressure lies. NVDA is down 0.55%, TSLA is taking a bigger hit at -1.04%, and the staples like AAPL, -0.45%, and MSFT, -0.79%, are drifting lower. The sentiment here is that the easy money from AI hype and speculative growth may be pausing. Michael Burry's critique of Tesla underscores a vulnerability. High valuations tied to charismatic leadership can suffer sharp corrections when growth narratives slow or market skepticism rises. If Tesla's robotaxi deadline looms without a spectacular payoff, the stock is priced for perfection, and perfection is a tough ask in this environment. Conversely, we see activity among the asset managers and financial players. Cathie Wood bought $13.4 million of Robinhood stock. This is a classic Wood move, buying weakness in a highly volatile, narrative-driven stock, betting on a rebound. It's a contrarian bet against the market consensus surrounding Hood's falling price. The headline hinting that one AI picks and shovels stock could overtake Nvidia by 2026 suggests that while Nvidia is the current king, capital is actively searching for the next infrastructure play. They are not abandoning AI. They are rotating within the sector, looking past the current valuation peaks. The digital asset space offers a fascinating counterpoint to the risk-off mood in traditional equities. Bitcoin and Ethereum are both showing green, breaking the bearish trend of the stock indices. BTC USD is up 0.23% to $88,935, a staggering number that speaks to a persistent underlying institutional interest, regardless of daily volatility. ETH/USD is stronger, up 0.75% to $3,022.82. What's driving this defiance? In the traditional world, we see Ray Dalio warning about the dollar and George Soros's fund-making moves. In the crypto world, we see Larry Fink's associates enabling tokenization on the XRP ledger, moving $200 million of real-world assets, RWA, onto the blockchain. Michael Saylor is making MicroStrategy interesting purely on the basis of their Bitcoin holdings. This highlights a growing realization. Crypto is transitioning from being a pure risk-on speculative asset to becoming an alternative financial rail, perhaps even a hedge against the very instability Ray Dalio is predicting for the US dollar. As traditional institutions tokenize assets and regulatory clarity slowly trickles in, the digital space maintains a positive momentum that equity markets are currently failing to match. As we look toward the immediate horizon, the market's cautious drift suggests we are waiting for the next major catalyst. The job market weakness combined with easing inflation has put the Fed in a highly complex spot, the infamous narrow path. The fact that the dollar is flat, gold is soaring, and major indices are down suggests high structural anxiety. Traders are betting on a soft landing that might require rate cuts sooner than the Fed currently signals, or they are deeply concerned about geopolitical escalation that gold prices perfectly reflect. We should watch the yield curve closely tomorrow. If the short end reacts more strongly to the jobs data than the long end, it signals that the market believes the Fed must cut rates to prevent an employment disaster, even if inflation is slightly sticky. We are also watching for follow-through on the major tech earnings narratives. Is the AI euphoria finally meeting the reality of complex implementation costs? If NVDA continues to slip, it will drag the entire QQQ down with it, regardless of macro inflation numbers. So, what's the summary of this moment? It's a market in diagnostic mode. The 24-hour price action shows a mild risk-off sentiment, but it's being countered by significant capital flow into defensive assets like gold and persistent interest in digital alternatives like Bitcoin. The core conflict remains. Are we heading toward a Goldilocks scenario where inflation cools perfectly without crashing the job market? Or are we entering a period where economic acceleration, Goldman Sachs' view, gives the Fed cover to keep rates high, crushing valuations like those seen at Tesla? The uncertainty is tangible. The market isn't making a massive directional bet, it's tightening its seatbelt. It's paying its insurance premium, evidenced by that massive move in gold, while keeping one eye on the high growth engines, just in case the rotation back to mega cap tech accelerates again.